Today, we're at the Economic Club of Minnesota with Fed Governor Michael S. Barr. His message: both sides of the Fed's mandate, price stability and maximum employment, are flashing red at the same time, so policy has to move carefully. He's speaking in the wake of a September rate cut and amid a federal government shutdown, laying out what's changed in inflation, jobs, growth, and what that means for the Fed's next steps. So the lesson? Barr frames the outlook around conflicting risks. Inflation, which fell sharply from 2022 highs, has moved up again in 2025. He attributes the recent reacceleration largely to higher tariffs that raised the effective tariff rate on imports and fed into core goods prices, while progress in core services has stalled. Expectations matter. If firms pass on rising costs and households come to believe inflation will stay higher, price increases can become more persistent. Meanwhile, the labor market looks roughly balanced by headline measures, but is softening under the surface. Perceptions have deteriorated, and some early cycle groups are seeing rising unemployment. Policy-wise, the Fed nudged rates down in September, but remains modestly restrictive and is leaning on the Brainard principle, meaning when uncertainty is high, adjust gradually and respond as risks evolve. So, inflation is up and tariffs are central. So, Barr notes 12-month headline PCE inflation rose to 2.7% in August, with core at 2.9%. He links the spring-summer upturn to tariff hikes that lifted the effective tariff rate to about 11% by August, pushing up core goods inflation as services disinflation stalled. He expects core PCE to end in He expects core PCE to end in 2025 above 3%. The median FOMC path has headline PCE not back to 2% until the end of 2027, which would be the longest stretch above target since the early 1990s. I believe it actually ended in 1993. So, why don't we just look through the tariffs? So firms built inventories and squeezed margins to delay passing costs to customers. But that can't last. As inventories fall and margins normalize, price pressures persist and risk unanchoring expectations. Because tariff increases arrived in steps across sectors and countries, they don't behave like a one-time price level shock. For the labor market is how it's stable on top and fragile underneath. ADP data showed private sector employment shrank last month, where job creation has slowed since May. The job openings to seekers ratio, basically how many job openings there are to how many people are actually seeking jobs, is about 1. And the initial claims don't show a spike. But the unemployment rate's still kind of modest at 4.3%, and that masks a more vulnerable setup if a negative shock hits. Perceptions of job-finding prospects fell in August to the lowest since 2013, with some recovery in September. Unemployment rates for African American workers and young workers have moved up. Growth is mixed with shutdown noise, basically. So after a negative Q1, real GDP grew 3.8% in Q2 and likely remained strong in Q3. The numbers aren't out yet. So at least as of this recording, tariffs and lower labor supply are drags, but Barr doesn't yet see major growth risks. A government shutdown typically subtracts from growth in the quarter it occurs and adds to it in the next quarter when it's done. So policy stance is cautious and data dependent, like they've been saying for what seems like forever. No, it's an exaggeration, but so Barr supported the 25 basis point cut on September 17th, keeping policy modestly restrictive while moving closer to neutral. And then since then, consumer spending has come in stronger and PCE inflation moved up as expected. Looking ahead, if inflation drifts further from target, policy may need to stay restrictive for longer. If labor market risks intensify, the Fed may need to ease more quickly. Enters the Brainard principle, meaning the high uncertainty. When there is high uncertainty, they move more gradually to gather data and better assess risk balance before they make a decision. So in conclusion, Barr's bottom line is balanced vigilance. Inflation has reaccelerated, largely via tariffs, and could embed through expectations. The labor market is still okay, but by the usual gauges, but softer and more shock sensitive. Growth is holding up, with shutdown effects likely to wash out. In that context, the Fed is likely to move carefully, ready to hold the line longer if inflation persists, or to pivot faster if labor deteriorates. Not hawkish or dovish, just kind of sober about the dual risks. So this was basically a summary of his speech that he gave earlier this morning. I guess yesterday, actually. I also found through one of the sources something I was wanting to really show you guys. It's not going to be in this one, but I found a really long Fed notes about how they were kind of tracking where the rises and where the tariffs, where those price increases are actually landing, if that makes sense. Like if it's getting passed to consumers, if it's going to like the importers, or is it more like the actual people sending it over? But I'm not going to get into that in this one. I'm going to try to break it up to a few episodes probably. There's a lot of graphs and data that I need to sift through first, but just letting you guys know so you guys can look forward to that when I get that posted in the next few days. With that being said, I will see you guys on the next one.